What is going on, guys? I am Chase. Welcome back to the Intelligent Money Investing channel. And as you guys know, in my last video, I was talking about what I was going to invest my new $500 into the market with. And to kind of do a little bit of a follow-up to that video, I want to talk about why bonds are a good or bad part of your portfolio, and whether you should be buying them now or not, and whether you're kind of in the position where you need bonds in your portfolio. So let's get into this. I got a few figures to talk to you guys about. But before we do that, I want to ask you guys, if you could please take a second, hit that like button on this video. It really helps out my channel, get some more growth on here, which is absolutely fantastic. You guys have been showing so much support, so I really appreciate that. So let's talk about some bonds and really talk about them and kind of weigh their benefits against stocks. So I don't believe I'm going to be adding bonds to my portfolio, and I'm going to tell you guys why. And really, this chart will kind of show it all. This is a 50-year annualized return going back from, I believe it was like 94 or 64 to 2014. And what we can see here is that on $1 invested into stocks, the average return was about $112 after the 50 years, and with bonds, it's only $24. And as we can see, this really doesn't make that big of a difference until the compounding really comes into effect. Because as you guys can see, the annualized payout was about almost 10% for stocks and about 6.5% for bonds, but most bonds are going to be lower than that right now, and really this really fluctuates based on the time, and this is past history, so we aren't really assured that this exact return is going to happen again over the next 50 years. Bonds could very well outpace stocks in the next 10 years. Who knows? Just because of the high levels we're at. But what we're looking at here is showing that if you have a long time to invest and you are trying to build wealth, then stocks are going to be your best option over the long run, because stocks are going to allow you to have a bigger compounding effect because of that higher annualized return. So when you're looking into these bonds, you're assured your return, whatever percent you're getting on your bond, but what you're really lacking. One second, I'm going to throw this on Do Not Disturb really quick. So when we're looking at our bond return, that's assured. You know what you're going to get. You don't really have to worry about it very much. But you also have a ceiling for the amount of return that you can get. You have a high floor, but you also have a low ceiling. But with stocks, you could get a 20% return a year, while you also could lose 50%. Over the long run, the annualized payout, the annualized return for stocks is going to be higher. So that's why most people are going to say that especially when you're young, you should not have any sort of bonds in your portfolio. And I have another chart to look at for asset allocation and portfolios based on age. So from 0 to 25, they suggest 100% stocks and 0% bonds. And then every 5-10 years, the allocation switches a little bit more in favor of bonds. So if you guys might be asking, why is this? Why would somebody who's 25 want 100% stocks, but someone who's 55 only wants 65% stocks? Well, that's because as you get older, you really are going to want that assured bond income, and you don't have as much room and as much time to make up big losses in your stocks if you are an older person and you kind of are relying on that income, and you don't really have time to wait around for 10 years for your money to come back in order to pop out of the market. Once you're 75 and you're maybe retired and you're relying on that bond income, once you're retired, you're probably going to want mostly bonds in your portfolio, especially if those are able to sustain you. But in my opinion, if this is money that you don't need and you are, like, let's say you're 50 years old, but you're still building wealth, you still are striving for more, you're striving to have a big inheritance for your children when they grow up, I would keep a bigger allocation in stocks, but that's only if you have a high risk tolerance. If you don't have a high risk tolerance, the older you get, the more bonds you need to own, and the more bonds you should own. Now, we're in a little bit of a unique situation right now because of the high levels of the stock market. As you guys know, S&P has been hitting record levels many times over the last year. We're a little bit off those highs now, but still historically, we're still very above the mean PDE ratio level, all that stuff. The valuations are quite high. Nobody's really disputing that at this point. But so when we're at this point, it might be a decent idea, and that's kind of why I was thinking of putting some money into bonds, to kind of get that safe return if the difference between your return is either getting a 0% return, not having your money in the market, possibly getting a negative return in the stock market because we're at these high levels, we might trek down for a little bit. And Or your other option is to get a couple percent return per year in a bond fund that you know is not going to lose you very much money, but also isn't going to gain you that much money. So that would be a reason to get in there. I'm not sure if I'm going to do it. I'm still kind of weighing my options there, and I'd like to hear what you guys think on that topic. I believe I'm going to stay mostly in stocks because they will pay out those dividends. They will hopefully get some equity returns, but honestly, we don't know. A lot of things are uncertain at these market levels, and we can see that by the big volatility that's been happening. Just today, we've had multiple percent swings in the S&P 500 in the last week, 2 weeks, about a month. Really, we started the year strong, but now it's just been extremely volatile, which is exactly why you guys saw me get that big Goldman Sachs position as my new number one individual stock position, just because that's a little bit of a way to protect your downside in a market like this. Well, a company that kind of feeds on volatility is going to be a good way to, when I see that volatility, I can still feel good about my portfolio rather than being like, wow, I lost 3% of my portfolio today. That's such a horrible day. At least I have some of my portfolio still working for me. And something that it's really just that's kind of basically hedging your bets. And I think that's going to help me out in the long run. So kind of to summarize, over the long run, stocks are pretty much always going to give a better return than bonds. We just don't know what's going to happen in that short run category, which is why bonds may be a good idea for people that are younger than what these old ages that are on here, basically. So people that are younger, it still might be an option rather than the historical suggestion that all young people should be very focused on their stock positions and very minimally in bonds. So let me know what you guys think down below. That's pretty much all I got for you guys today. Please hit a like on this video if you enjoyed. Let me know what you guys think. Join that Discord chat down there if you haven't already. And also hit that link to sign up for Robinhood for free stock trading. It's a really useful tool, and I use the Robinhood app almost daily. Keep your guys' eyes tuned. I'm about to be making my 1 year on the Robinhood app review. I believe probably sometime in the next week. I started, or maybe early April. I started out, I believe, April 4th on the Robinhood app last year. So it's almost my 1 year anniversary in investing, which is pretty exciting. So that's all I got for you guys today, and I will see you in the next one. Thanks for watching.